Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, September 6, 2023. It is 10:57 Eastern Time as I'm starting the video, and we're going to cover in this order. We'll do a brief update on the equity markets, and then just everything else that I'm watching that I think is important to where the equity markets as well as other things go. In other words, interest rates, treasury bonds, I've been talking about the euro. It sounds like a lot, but it won't be. I hope to get this video done in under 40 minutes, maybe 30 minutes, because I kind of want to cover on all these things are related. That's why I don't break it apart. JP Morgan, that's one of it is the largest bank and one of the biggest financial companies out there. I'll continue to watch that. The regional banks, I want to do an update there. Very important sector to watch, in my opinion, because cracks in the banking system are cracks in the economy. Then brief updates on crude oil. I think it's time for another short on crude, natural gas, and maybe even a long opportunity there right now. Wheat and corn, I like those guys right now as well, the grains. So I'll try to get to all those in this video. Let's just start out here with the 120-minute chart of NQ. That's right here in the upper left-hand corner. Tells the security I'm covering. These are the NASDAQ 100 futures. Time frame is a 6-month chart with 2-hour candles. So I can go back, and this is really the one I've been working off for weeks, if not the last couple months now. This is the primary uptrend line right there. Very, very significant uptrend line. We put in a divergent high. We're building divergences. We had a divergent high there, followed by a correction. Extended those divergences right there into the mid-July highs and put in divergent high. And then as I've been talking about, we've been stair-stepping lower since. We're still above this previous reaction high. And for the last, what is it, almost a week now, at least the last several trading sessions, we've been testing the primary downtrend line off the highs. It's a relatively minor trend line. It starts back there again, mid-July highs. But on this board, this version of it, I have a different QQQ, tells a little bit different story. I'm going to get to that in 1 second. But this so far is just a back test of the trend line in which I expect to see a rejection. That still and has been remain my preferred primary scenario. Targets are marked here. Thick lines are the more significant levels. We already undercut that one. We already tested that one and slightly undercut it and then tested it again there, and that's 14,855. Being that we have, I expect little, if any, reaction the next time around because we already got my reaction. That's how my price targets work. The initial drop to a support level or price target from above. Typically, you're likely to get a reaction off there. There's the reaction, and then that's done. So it doesn't mean we can't have another reaction. It just means now that I don't think we will, especially because it got taken out a little bit there and there. And so there it is. So the next stop, 14,427, 14, more minor support about 14,139. We'll call it 140, 14,140. And then down here, 13,503, and then 1386. And I'll still, at this point in time, I still can't rule out with any degree of confidence, high degree of confidence, that is, that marginal new high scenario. But I'm going to show you a couple things that increase the odds that we're going to stick with my primary scenario. In other words, not going to have that marginal new high. And that would be, let's jump over to QQQ real quick. So here's QQQ. This is the version of that downtrend line that I have off the highs right there. Breakout. As I mentioned at the time when we broke out, it was a very low volume breakout, and for many decades, not years, but decades, I maintained and learned early on that breakouts that occur on below average volume. You want to see at least 1.5 times the average volume. I spoke to that day. You didn't see it. So the breakout so far, there's been lack of follow through. Now, we want to see, and if you're a bull and you're looking for the new highs and maybe even beyond, then this is what you do. You buy a breakout. If you didn't buy the breakout, you buy the back test of the trend line. Now, I think it's going to fail. Then this is a very, very significant trend line right there. This was the one I showed you at the beginning of the video on the 120-minute chart, a shorter term trend line right there. I believe that was the same one. Just a little bit going back a little farther here on the daily. And then this is the big important trend line there. That comes off the really the late December, early January lows. Lots of nice clean reactions on it, including two more recently. And then boom, lights out when that goes. And then there's still that level I've been harping on for now last couple, at least the last few weeks, that the reaction low from Friday, August 18th right there. And that's about 354.70. That's my lights out number, because you take out the trend line, and then really, for reasons I stated before, I think that level is going to be pretty important. And then minimum I see us going down here if we get those two sell signals, and that's 321.87. That still gives you, if we get there, about from where we're at now, about another 14% downside. And from where we got the earlier sell signals, that would be a swing or trend short of 16%. And please don't get me wrong, nothing's changed on my longer term view. This is just an area where most likely be looking to game a bounce. If we get there, we covered some shorts, go long. We'll see. And remember also, you have the 200-day moving averages. There's your exponential and there's your simple coming in. My guess being with the simple is closer to that this target here, that 322-ish level. That if we get down there, we'll probably that's the one we'll probably grab and get a bounce, even if it's and I think it will be. Let me just say this now, and this is what I call kind of micro predictions, that not only, okay, if we do get there, let's just assume I'm right, we're probably going to get there in a pretty swift order. As we come up to those moving averages, once these levels go, I expect very impulsive selling, kind of 3% plus down days, and then another one. And so that kind of stuff, you have that downside momentum. You will likely overshoot the 200s at least for a day or so. If and there's a lot of ifs, guys. We're still back testing this level. There's still price support here. Anybody's game, but my job is to show you the levels and the developments and things I think are important, both developments that have happened and, as if not more importantly, potential developments that could happen and to look for and react. That's what trading is all about. Nobody knows with absolute certainty where the markets or any stock are going, but the way it works is just increases odds. Break support, fail the breakout here, then break the trend line. Those are just the odds, the probability of a much bigger drop, go up sharply as and if those levels are taken out. Now we start to reverse here, and we go out and we take out the recent highs, and things change, then maybe that's gonna or would increase the odds for that divergent high, marginal new high scenario, which to me, again, is it's simply, I define it as a near-term bullish, longer-term bearish scenario. And then anything much above that, in other words, we take out the divergences, we go up more than 5-8%, even let's just say 5-6% above that previous high, then that's just wrong there, and the markets are doing different things, and so is the economy. All right. Okay, so I started to screenshot a chart. I just figured I'd do a video and include it here. This is one of my favorite volume indicators. This is one I came up with many years ago, and if you look down on the bottom, what you're looking at here is a chart. I just put a simple line chart on QQQ instead of candles, just to kind of show you this. And I have 3 levels of horizontal levels here, horizontal lines, and they show volume. In other words, this one here is at about 44.5 million shares traded on QQQ. So this is your daily chart. So these are your volume bars. The white bars, these vertical spikes, are the daily volume. Now what I like to do, and I created this indicator years ago, probably 15 years ago or more, because it's something I noticed that I have different lines at different levels, because depending on different market conditions, those lines are what comes into play and mark, my sell signals. You can see back here, it was the red line that would do the trick, and you'd get to this level, boom, you fell to it and you had a correction. You fell to the volume. Again, not the daily volume, because what using a 10-day or any moving average will do is smooth out. You're always going to get one-day spikes in the volume bars based on news events and Fed announcements and things like that. So by putting a 10-day exponential moving average on the volume, remember, this is what it is. It's on the volume, not the price. That then smooths out the bumps, and that's what I like to use. So here's the thing. This is a pretty impressive indicator in my opinion, and it's fired some sell signals recently, including now. So pretty much at that level, when we hit the purple line, since this is the start of the bear market right here, guys. This is when the S&P 500 peaked right in the beginning of January 2022. The NASDAQ 100 technically, but a slightly higher high back in November, but made about, you can see here, an equal high right there in the beginning of the year. So that is the official start of the bear market, which I believe is still underway, and it's been a bear market rally, and we'll see. Either way, say what you want about it, but here's what's hard to argue. There's that, boom, you hit the level right there. Perfect timing indicator. It got you all the way, that gave you that. However you want to call it. You want to trade that. We were long this and we were short that again. Then we gained these counter trend bounces both. But this helps show the inflection point. So, what I've noticed is, during a rally, when you see volume tapering off, it's just showing you the buying pressure is drying up. It's not rocket science. It's similar to how I use momentum indicators, divergences, and all that, but this is something else. And it is divergence, actually. What's what it is. It's prices going up with the average, with volume going down. And then it just, again, it's simple. It shows the buying pressure. The buyers are drying up, at least for, that period of time. And then you get these turns. So boom, you hit it there. And right after the top was in, it told you, hey, the low volume indicator fired a sell signal. We had a nice rally here. Boom, hit it again. That rally, volume picked up. There was a lot of volume, but you hit the indicator there, and then you got this. And these are all double digits, all these. This one came very, very close, but didn't hit the line. If you want to say that it hit it, you can call it a whipsaw. There was a little correction after, so let's just chalk that up to being a whipsaw. You hit it here, very close, and that came right before the top. So again, it's not an exact timing indicator. My exact timing indicators or signals are breaks of support. Let's say it's a horizontal support level or an uptrend line or a wedge pattern. Boom, you break out, and that is an instantaneous buy signal. That's a timing indicator. These are more of kind of like divergences, but more of a timing indicator because they're close. The tops and the bottoms come close. And I just wanted to point out that now we've dropped to, you can see this QQQ volume. I'm going to put up a line here. We're right here, and we haven't been that low since right here at the top, right in the beginning of 2022. So boom, that's fired a sell signal, and I use it on the S&P 500 as well. You can see here right at the top, this is where volume fell to right here. That again, the 10-day exponential moving average of the volume. You hit or cross that line. Well, you had a hit right there. So this one, you might have to pull this line down a little, something like that. It's not a perfect indicator, but it does pretty good. So when you get down to these levels, when you have a rally and volume drops down, that's usually when your inflection points come, meaning the turns in the market. And again, being that it's the way it's used, it's going to call tops, not bottoms. Bottoms usually come on selling climax and volume spikes and all that. And that's it. So I just want to say we're down there. In fact, let me just show you where we're at now. Put up a line, grab that yellow line, that little tool. And this is where we're at. So the last time we've had volume that low on the S&P 500 was right here. And we crossed that level right there. And boy, wouldn't that have been nice? And we rallied up, we traded that long. And I believe reversed it on the button. It was a confluence of 200-day. We ran into a downtrend line, 200-day moving averages. We had 60-minute divergences and all that stuff. But this was a confirming, get out of Dodge kind of signal. So there it is. Anyways, that's it. If you're listening to my voice, it means you've hung in there lately. It's been a kind of a grindy, choppy market. I look at the S&P. Looks a bit head and shoulderish now that I look at it this way. I'm sure that's probably been pointed out elsewhere, but You get the left shoulder right here, head, and a nice looking right shoulder. And there's your neckline. So a break of that would give you a measured target when you have a head and shoulders pattern here. Let me mark it up let me find a clean board here. Let's see, we'll just use this one for now. Draw it up, neckline, left shoulder. I just put a note for now. I'll make that annotation, put the annotations in later. Head, right shoulder, and then measured target of a head and shoulders pattern. Remember, that's that bullish or bearish engulfing candle right there that we put in so far. It's marked the high in the S&P 500, and then you add the measured target, which is a distance from the top of the head down to the neckline. You add that to where the pattern breaks down. So if my assumptions are correct, we just fire that sell signal and volume. If we continue down, then that would take us down here, and that happened to be a level you can see I already had a support level there, right about where the measured target is. So that's that. Let's move on. Let's look at a few other things, so it won't be a super long video. JP Morgan. Again, I like to look at things that no one else is talking about before they happen, and again, it may or may not be a thing going forward, but so far I've noticed weakness in the most important bank or the most important financial institution out there. You know, Visa's larger by market cap. I believe that's the only one. Let me confirm that recently. Yeah, and the XLF, which is a financial sector ETF, Visa is the largest financial company, but that's, again, it's a credit card company. It's a $510 billion company. JP Morgan's the second largest at 429, but it is the largest bank. So there's XLF. And again, so problems with JP Morgan would be, well, you know, let's say the problems, just right now the stock's going down. This isn't like a red flag, get your money out of JP Morgan Chase. No, I'm not saying that at all. I'm just saying, you know, the market was, you know, looking and everyone thinking it was going to punch through new highs, and maybe it does, but you know, JP Morgan broke down recently, as I pointed out, and also pointed out you had a flag going here. I have to turn off all the lines. So you had that impulsive drop and then a little flagging action recently right there, and breakdown candle, and we're still moving lower. So one to watch, because it might not be they might not be talking about it now, but if JP Morgan moves down here, takes out the 200-day moving averages, you're going to get some of the bobbleheads coming out on TV and saying, hey, what's going on, you know, with the banks right now. And JP Morgan, remember, already broke the trend line support, and that was a couple weeks ago. This is the big level to me here, about 143.85. So I just wanted to update that one. And there's others out there. I'm just picking on the biggest one. And KRE, regional banks, I mentioned back here a few weeks ago that it was time, I think, to start shorting those again. Left them alone for a while. And then put in this, they started flagging. They had this impulsive move down, flagging. They broke down today. So that could take us down more. Something to watch. If they can move up here, then they foiled that potential flag. But either way, looking at this, I think there's more downside. And again, it's something to watch. I wouldn't put any kind of red flags on the financial sector right now, or the banking sector. Maybe a yellow caution flag, I think, would be the right term. But again, something to watch, along with interest rates, treasury bond yields, the US dollar, the euro, and all those other things that I think are very important at this point in time. To be long or long and bullish KRE, or short and bearish, is to be the same on IWM, because IWM has a very, most of those regional banks, just about all of them are in the small cap index. So there's IWM, and it's just going to follow. So if you wanted to trade with a little less risk, instead of shorting KRE, then you could short IWM and probably get to the same place. But remember, you also have a lot of other, you know, roughly 2,000 companies in the Russell 2000, and so you have more diversity, and so, you know, KRE is more of a pure play. Let's just jump over to USO, because I think that's a short. It ran into resistance yesterday. This is a chart I've been sharing for a while. I haven't modified. I think this trend line's been here. Created that back in 2022, July, so over a year ago. and it's pretty good resistance. It was support, then resistance, 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 and we just hit it yesterday. We hit it with negative divergence, and so that's it. I think crude's had a nice run. We shorted that pullback recently. We hit T2, remember, on the 60-minute chart, and at T2 we hit that, so there was likely bounce. And then the last update I gave you said you can short it here, but I made it very clear that I wouldn't be, I didn't like it if you didn't already have it. If you covered, you've been gaming, you had a lot of profits. I pointed as an objective level, but I made clear that the risk reward was no longer nearly as favorable as it was when we first shorted it back here. Actually, I believe we shorted it before the breakdown in anticipation. Hit our first target, bounced, hit our second target, bounced, and now then we're back to resistance. So that is the first an objective short entry. There's long short entries all over the place, and again with negative divergence. So this one has the potential to be a pretty good down. Again, the potential if the stock market goes where I think it's going, and if we're not going to see new highs, and if the stock market is going down, about to embark on another double-digit plus drop, because you'll probably see crude being sold on expectations of demand destruction. So, lately it's been going up, and, a lot of that has to do, I think, with the BRICS all banding up together, Brazil, Russia, India, China, and South Africa, although they don't play in that much as well as, but the majority of the world's oil producers now are all, buddying up. And they don't really care for the US. Oh, and Saudi Arabia's in with them too now, really, for the most part. So therefore, there's concerns about what's going to happen with crude production. However, I think that's been priced in, and all I can tell you with certainty, forget about my fundamental ramblings, we're at resistance with negative divergence right there on the daily chart. So you take a shot at resistance with a stop somewhat above in case the resistance is popped, and you have an excellent RR. I would be looking for a move back down. I'd be looking for a move, just kind of let it run for now, see how the charts develop. Because if the stock market holds on and punches up and ignores that low volume sales indicator and does make that marginal new high scenario, well, that certainly isn't going to support the case for demand destruction. Doesn't mean crude can't go down, but crude tends to rally with the stock market for the most part. All right, so there's crude oil, short trade idea for you. UNG is natural gas is pushing this level here. Lately, it's not super well defined, but I did have a line there. I've had this line here since, created that back on July 13th. And you can see it was resistance. There's quite a few reactions there. We popped it, breakout candle, rallied up. We were, long from back here, hit T1, T2, got rejected off T2, my second target, pulled back, hit it there, hit it there, hit it there. We're below it now, so that is a breakdown, but a hair below it, and then what I see on the 60-minute chart is positive divergence. So right now, I like short crude, long natural gas. They've actually been moving pretty inverse to each other lately as well. And so you can see you get some positive divergence, just like back here. And that was the last time I think I pointed out. Divergent low, breakout of the wedge, back test there, and it rallied up. It's been a swing and trading vehicle, active trading vehicle. It's not a buy and hold thing yet. Maybe soon. There's still those big divergences. We're coming off that divergent low on the daily chart. But as I've been saying for a long time, we have this trading range. We need to punch above it. And that means we need to punch above T2 to open the door for a much bigger run. Right now, all I can tell you, it looks like an objective entry with a stop below the recent lows. Maybe today, keep it tight. You don't want to, play around, give the Widowmaker too much room. So you can take a shot there, or, stop slightly below if that's your thing, if you want to give it a little more room. And worst case scenario, you get stopped out for a couple of percentage points. That's it. We're talking like not even 2% below those recent lows. And your upside potential, I would say at least to right here, about 738. That's about 13%. That's a tremendous risk reward ratio. So there it is, where you take it, leave it, up to you. Wheat. I like corn and wheat now. It's something else I took today is wheat. PPO is poised to turn up. I like to see these, bullish crossovers. Hasn't made it yet. This was whippy here, but it finally crossed over there for good. Put in a nice reversal stick there. Rallied up and we caught that T2. We turned around. We actually shorted it there, or a post on the site. That's what I did, and caught that pullback. And we rallied back up there. So this is the big level now. That former where those T2 was actually just below it. That was that line. But now we've set up those two levels there. So I'm going to add that now. That's those two recent highs were right about there, a little above that. And this is a potential bottoming play. We put in big. This was a divergent low, remains the low, the divergent low right there. And this is pretty much almost just a back test. So it's we still have the positive divergence. All you have to do is pull the line forward, and the divergences that have been building for a while now are only bigger than they were at that previous low at the same level. So potential double bottom there. Positive divergence here on the 60-minute chart. There's not a lot not to like for me, but believe me, I'm contrary to a very contrarian investor. I catch tops and bottoms, and so most people are looking at this saying you're crazy. You're trying to catch a falling knife. This isn't something in a clear downtrend. Well, that's where I was long here, and I was short, selling there and going short. So, and then long again. This is what I do. So, doesn't always pan out. And so if they always say, those who try to catch falling knives get cut, just set a stop. Don't get married to it. If it takes out the divergences, no good. Where's your stop? Well, your stop's going to be dependent on where your target is. If you think, like I do, this thing's going to, I think we'll either, ultimately we're going to come back up here and test those 2022 highs, if not more. But as of now, these were swing targets established back here off that divergent low. T1 was hit, T2 was hit. Again, active trading, get out, get back in. And the next rally up, since we already checked that level twice, I think we'll come up here at least T3. And if we do, maybe we do, maybe we don't. If we do, that's going to be about a 32% run from where we are right now today. So wheat looking good. Its partner in crime is corn. They tend to move together. And there it is, just nice long-term support about 2188 or so. And just like wheat, put in a divergent low here, big positive divergence that comes all the way back from here. There's your divergence. And it's not like it didn't play out. We had a rip there, corn ripped up, hit resistance, pulled back, made a new but marginal new low, only extended the divergence, and it just made a couple tests of that previous low. So it's really basically just keeps holding this 2188 support, long-term support with positive divergences. So it's simple. It's buy it here, stop somewhat below. They've already, if it's already tested that level several times, it could punch it. That's why somewhat below keeps you in case they want to do these little shakeout moves where they just take it down and then run it up. But I think because the constructive charts on the 60-minute, I don't think we're going to get that now. We have positive divergence at that recent low. Corn nor wheat, they're not really taken off yet, so I can't rule out that marginal look. If it does, it's going to look like this. Just extend the divergences. So again, you can see I'm going to move this line down here. So this is where corn keeps falling to and the buyers keep stepping and buying it. And this is technical analysis 101. When you just see a well-defined level of support, you buy pullbacks to that level, and just know that the algos and the nefarious forces out there will sometimes try to take it down, make it look like it's a legit breakdown, and you don't necessarily have to take that breakdown. What I like to do, if they stop me out, let's just say I have a stop right there and they take it out, but then they recover it, I'll jump back in because that's very bullish. If you see that, that's a stop clear move. They shake out all the weak-handed longs, and they suck in some short sellers. And so once that level's recovered, the shorts realize they're wrong, that breakdown failed. They start to cover their positions, which means they buy it. Longs will jump in. However, we may not get that scenario. So I think it's objective long here. And, maybe you take a starter position and add either on a little whipsaw or if we continue on up. I don't favor the whipsaw. I just want to mention it's a possibility. I like these both now long. Favoring wheat a little bit over corn. That's the only one I took today. I may layer into corn as well soon. What else for you? Well, we're almost right at the 30-minute mark. I'm just below it now. So there's those pesky little treasury yields. Yep. A few weeks back, everybody had written them off, and now here we go. A lot of treasury issuance going on right now. Hit that trend line again. That's a primary uptrend line, a very, very significant uptrend line. We remain above trend, and we also are flirting with those previous highs, multi-year highs, multi-decade highs right there, back from October of last year. We just hit it recently, got checked. You know, anything much above that, you're going to break out, and yields are going to rip the new multi-year highs. This is, remember, when we hit it back here in October of 2022, that's where the last time yields were there. You got to go back to October of 2007, which was when the market top, when the last real bear market started. And so anything like this, like I've been saying, it's an incremental, but increasingly, I think the market will become increasingly hyper-focused, or I should say hypersensitive to increases in rates once you break out above those new highs. And so this would be, in my opinion, very bearish for the equity market. Whereas should we turn around, break the trend line, yields start to fall. I've already given you two scenarios, scenario A and B. Scenario A, if rates do this, only because of natural, let's say, for the lesser part, natural market forces, meaning there's no cracks. The banks are okay. The stock market's doing fine. Economy's okay. It's just expectations of lower rates. That should be bullish for equities. Right there, you check mark. However, I think the most likely scenario right now, in my opinion, is we see an abatement of yields, even if they pop first and we break that trend line, because the stock market's selling off hard, and there's that flight to safety bid that I talked about with institutional investors like pension funds and whatnot, selling stocks and moving into bonds because they realize the whole, it's funny how this market's trended. The hard landing scenario was eliminated a couple months, a month or two ago. And then most big firms even eliminated the soft landing scenario. Now I'm hearing more and more talks of soft landing. Still not hearing hard landing. And if you get to that, that's where you'll see the stock market dumping. And I think that's where we've been. I think everyone just kind of got ahead of themselves on underestimating the lag time on these rate hikes and things like that. And then just ended here. I don't have it in front of me because I didn't queue up the charts. You can pull it up, look at the dot plot for Fed funds rate. The market has been and continues to expect this sharp drop off in the federal funds rate, meaning the Fed will not only stop raising, but they're going to start to cut substantially over the next year or so. And it's insane because, why would they do that unless there's cracks, some serious problems in the system? I think people are just thinking of reversion to the norm, like we're going to stay at zero and go back to a zero rate policy and stay there forever. Remember, the Fed kept rates artificially low for over 15 years, since 2007, even before that, really since the dot-com bubble, we've had below where the natural, forces based on rates of inflation, other things, where rates should have been. So the market thinks they're going to do this. All the Fed has done is normalize rates back to, where they should be. And so there's no reason, there's no fundamental reason you can see, the Fed cutting rates sharply unless there's some serious stresses in the economy or the financial markets soon. So it's insane that and by the way, those are the smart money. They're usually right. Bond traders and federal fund rate traders, that in the short-term rates, way more often than not, they're right. And it's just crazy how the stock market is not pricing that in. The Fed funds futures are pricing in something big happening that's not good, and yet the stock market's flirting with multi-year, highs right now. So one of the two's got to give. Either the Fed funds future traders, the pros, the smartest people on Wall Street, are going to lose a lot of money making those bets. And this is driven up by, you might want to wonder why they're, why the stock market's not going down, because retail traders move the stock market. And the institutional traders affect it, certainly, but you have the entire world trading QQQ and buying NVIDIA with the AI bubble and all that. And very few, if any of those, Schwab traders are trading federal fund futures or even U.S. Treasury bonds. So that's what happens. That's where you get these disconnects, right, there, between the stock market and what the bond traders are seeing coming. Okay, so that's it. Just kind of interweave it all, take it all together. Watch the euro. I didn't cover that. I'm going to wrap it up here at 35 minutes. But that same thing. The euro, the dollar's been rising. The euro's been falling. The euro and the stock market are positively correlated, meaning they're going to go up and down together. And like I said, interest rates right now are probably the biggest thing to watch. Oh, and employment. We've got the numbers, I think, coming out Thursday, jobless claims, if I'm not mistaken. And I've been seeing that uptick. We're seeing the uptick I promise you no more charts. I promise to wrap the video up, but I really meant to cover this one. Very important. That is always the last thing to buckle. And every, perma bull they march out on TV cites the one thing, and you got to give them it, until the consumer buckles, the stock market or the whole hard landing case is not on the table. Soft landing isn't going to happen or could happen, but not if employment stays strong, because the consumer spending accounts for 2/3, or really closer to 70% of GDP. It's everything for the economy, for the stock market. And unless the consumer buckles, you're not going to see a big drop in the stock market. But, big but. So this is the national unemployment rate. And here we are. And what I wanted to point out to you, and I've talked about this a lot of times, I'm sure you hear a lot on TV, is that, okay, so we're at record or multi-year lows. We're towards the low end of unemployment. But one thing, if you look at this, these shaded areas right here, right, these are the recessions. There was a little blip there. That's the COVID recession. One quarter was over before you knew it. If you blinked, you missed it, right? But it was, as far as 2 consecutive quarters of negative GDP growth. And so you can see all the recessions. Now, here's what I want to point out. Okay, so why bulls, and I get it, will use that as probably their strongest selling point for buying stocks for long-term investments. The stock market's going to go up as a low unemployment and consumer, the consumer holding up. Look at first of all, look where we are. We're at I think it's very clear, the tail end of the range. We had higher, levels back here, but historically, that's about as low as it gets, right? So I think we can all agree on that. And also look at this. It never stays I've studied this chart many times. It goes down, 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 down. Never have I seen it go down and stay low for any period of time. It drops, and then it just turns and goes the other way. So that's all you can say, is that when you get down to these levels, number one, you can say it never stays there. This is the longest period where we had, extended low unemployment right there. So there's a little bit of an exception, but usually you hit that point, that spike low, and once it turns, it goes. It's an inflection point, and that's it. And so we're seeing that. And that's why I'm watching these unemployment numbers very closely, because I think as important as interest rates is this. And so this is, and I'm not the only one. So watch that's on Thursday, I think it is, the next report for employment data. Yeah, just go to the website, click on resources right here in the top menu, and then click on economic calendar down here under tools of the trade, and you'll see jobless claims. Yeah, it is Thursday at 8:30. So this is going to be a big one to watch this week. And of course, you can click on it to kind of get what the consensus is right there. 238. There's your range. There's your prior number. So you can see it's been ticking up. Like they used to give you the chart here. You can, again, I just showed you the chart. That was on what, it was a macro trends. Yeah, that was, the site is macro trends. Yeah, and you can go in, you can zoom in, go in 5 years. You can see it leveling out. And so really once you start to clear out this little kind of basing range there, if you start to see it move up and take out these previous highs, that's where I think the market's really going to start to take it on the chin. Okay, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.